Hey everyone, it's Brendan Mohr, the Realtor. I'm just here for a market update today. I haven't given one of these in quite a while on a video recording. Get a lot of questions about what is going on in the real estate market. So let's get into it. I'm going to share this first screen with you as you see Mortgage News Daily. It's a great resource to show daily changes in the mortgage world. Uh, this right here, 30-year fixed rate. Now I'm not a loan officer, so I always reference either a loan officer or a database mortgage surveyor like Mortgage News Daily. This number right here, where it shows minus 0.6%, that's very significant for a single day. Now, there was time that the daily fluctuations of this would be something like 0.01, 0.02, not over 0.5%. But that's what the mortgage rates did today. And today is November 10th, 2022. A big thing that happened today was the Consumer Price Index report came out showing that inflation is much lower than expected. So the outlook on that caused interest rates to fall. And something to always remember with mortgage rates is the Fed rate doesn't necessarily dictate what mortgage rates do. They're kind of going on the same data. And mortgage rates tend to look to what they think the Fed rate's going to do, though. So current mortgage rates have what is factored in as likely two rate increases by the Fed. So you might hear maybe next month that the Fed raises rates 0.75%. The mortgage world has already factored that in. So anytime that you hear that, oh my gosh, the Fed raised rates, doesn't mean mortgage rates went up. In fact, a lot of times rates end up going down because the data released on that day wasn't as dire as maybe it was anticipated. So here we are today, huge rate reduction. We were at over close to 7.5% if you went back to this time last week. So now rates dropped 6.62% on average. That's a conventional 30-year fixed rate. I believe 20% down for that particular rate. If you're new to the mortgage world, I mean, you can get mortgages for 1% down. So that's a huge reduction. Now, let's see how this correlates to home prices. Let's go over to this data here. So this is the trends for the Sacramento County. It's all of Sacramento County, and this is November's report, but that goes to the end of October. So let's just go into some of the data here. This first graph here shows homes for sale, homes sold, and this red line is pending. But what I really want to focus here on is the date of October 22 all the way over here to October 21, by year, of course. So on market, we had 800, or rather solds. We had 851 sold listings compared to 1,595 last year. And that's quite a few fewer sales. Part of the reason for that is, just there's nowhere near as many buyers out there as there were back then. And it's just because of affordability. Interest rates more than doubled. We were sitting at about 3% for a while, and then got up to about 7.5%. Again, down to closer to 6 and 2/3 today. You're also seeing inventory. This light green line here, that's homes for sale. So you see back in October, there were, it's hard to see the number here, maybe 1,533 for sale, whereas 2,077 up here. So, that's a significant increase in number of homes for sale. Now, the reality is what's really happening is far fewer homes are actually coming on the market. It's just that there's far fewer sales. So this inventory level is going up and a lot of homes are sitting on the market. So inventory is up 36% year over year. And sales are down 34% year over year. Now let's go to this next graphic. Now this is a metric that I like a lot, but you really have to fine tune what you're looking at. But this is dollar per square foot. You can't really use dollar per square foot in a lot of cases. You really want to make sure that the land size is smaller. or relative to really the data that you're looking at. As you can probably imagine, if you're looking at homes that are a half acre, an acre, even larger, the dollar per square foot really pertains to the square footage of the house. So the dollar per square foot in that case, when the higher the acreage, it's going to be a larger dollar per square foot for the house as well. So in this particular case, I'm looking at a quarter acre and under, which that tends to be a pretty common size in Sacramento County, under a quarter acre. So you see this dollar per foot, 325 back in August of 21. Now, back in October of 21, we're looking at 319, and that got us all the way over. This is when rates really started rising in March of 22. Here's April, and here's May. The reality is that typically an escrow on a home is 30 days. So something that closes in May is an offer that was accepted in April. So this is in April. Here is when rates really started to make a jump, and people started kind of panicking. Let's get in before rates get real high, which was probably a good plan for them, because rates were in the about the fours for the most part, to maybe fives towards the end. So we're looking at 358 a foot back at the peak in May of this year. And since then, they've fallen. Here we are, October, and this goes through the end of October, 327 a foot. Now, the interesting part of this metric is that in September, it was also 327 a foot. So you see it falling, and now it's stabilized. So that shows you that the market is essentially stabilizing. Now, changes in rates can definitely change that. We'll see what it shows in November. Maybe that falls a little bit more. November, December tends to be the slowest time for real estate sales. So I would not be surprised if we saw that fall a little bit more. And then usually somewhere around mid-January, we start to see that ramp up again. So there we are, dollar per square foot changes. Now this number right here, 327, is actually up year over year 2.5%. So that still puts us up year over year. Now we are down 9% from this part right here, 358 a foot to 327 a foot. So it's something to look at if you're going to sell your home and you're thinking, oh, the Joneses up the street, they sold their house for whatever it is, $600,000. They sold it, closed back in May, June, even July, maybe August. You see how you can't use those comps anymore. We're going back maybe a month, 2 months to look at comparables. Now, if there's something that sold in May and this is a 9% drop, I'm looking at, that maybe this is continuing. I'm thinking 9%, 10%. So, a home sells for 500,000 back in May. You're coming over to October and November now. If you're going to list the home, you might be looking at, 450 for that. The interesting thing is, for people who are waiting for home prices to drop as the interest rates go up, those interest rates have not dropped in conjunction with the home prices. So, for example, you may have a purchase that you're making, like a $500,000 home that you saw maybe back in May, and you're going to put 200,000 down. Let's say, just say you had a whole bunch of money. I'm just trying to make the numbers easy. So you had a $300,000 loan. Well, so $500,000 purchase, $300,000 loan, whatever that monthly payment would have been. You go over to today, that 10% drop, now $450,000 house. You're thinking, okay, great, 50,000 off that home from the peak, but the rate is quite a bit higher. But you have all that cash, so you're going to need a $250,000 loan instead of $300,000. But that $250,000 loan is costing you more than that $300,000 loan. So that has been a little bit of the issue with affordability. Will that level off more? It's yet to be seen. So let's go down here to the next graphic. Now, this graphic will show us this number here, percentage essentially that a home sold at or over under the list price. And it might surprise you. I get this a lot from sellers that when they overprice their home and they're not seeing offers on their home, and then they reduce it by 10,000, 20,000, and they start getting offers, and they're wondering why didn't people just offer 10, 20,000 under? It's just something that's in people's minds. Maybe it's because of how it is in retail stores. You don't go and offer under what you see, whatever it is, a TV or a vacuum cleaner or whatever your groceries for. It's actually not as common that people will do that in even real estate. So if you're pricing a home at say 500,000, just hoping that you get that number, but the comparables and the other data, you're looking at what homes are pending for, are telling you otherwise. And you're thinking, well, maybe someone will offer me, 480. Most likely, they're just not going to until you put that list price lower. It's also in how people search for homes. If their pre-approval from their lender says your max purchase price is 475, most of those people aren't looking at, they're not setting the parameters in their auto search system. They're not going to realtor.com or Redfin or wherever and putting in 500,000. They're putting in 475. So it's something to think about when you're pricing a home. But here you are now seeing homes sell for under the list price. Some of that is going to be offers. Some of it could just be low appraisals, and the appraisal world is a whole different subject. I could talk for a good hour about what an appraisal actually is and how that affects a sale. But back here in same month last year, October, 101, so 1% higher than the list price. You're going at the peak somewhere around. Well, the peak I was telling you was May, but looks like 103, so 3% higher, 4% higher in April and March. Now we're 95%, so 5% of the list price. Now I don't really like this metric that much because it's really related to what the list price is, and if sellers are looking at comps from several months ago and just simply overpricing their homes. You really do have to factor in that there's going to be some homes that are priced to the market. So you can't just make an approach to the market and saying, looking at this and saying, okay, 5% under, looking at a $500,000 listing and saying, hey, okay, I'm going to offer 475. That particular home may have already factored in the market. So it's a case by case scenario, which is really the case with practically anything out there in real estate. Now we're going down to this next metric. Oh, one thing I didn't talk about here is average days on market. So these are average days on market right here. October of last year, 17 days on market. It was a hot market. Homes weren't seen around. We can talk about why it'd be an average of 17 some other time, but now 36. Now, the interesting thing about 36 is that's actually about the average days on market that you would see in the healthy markets of, say, 2017, 2018. It started to get a little bit hotter in 2019. But that's not a bad average. So that's actually somewhat of a normal number. Okay, now we're going to go down to this is average price for sale and average price sold. The only reason I ever look at this one is it kind of tells you that the homes that are being sold tend to be the ones that maybe are the lower price, and just seeing where this line, the red line and the green line separate. You can see in that really hot market that the line was really, really close. And as the market's getting a little bit weaker, you see it start to separate. And that just tells me that more people are buying the lower price homes, and that affordability is an issue. So you've seen 555 is the average sales price, which is actually equal to 1 year ago in October, and the price for sale is about the same too. Okay, this is going to be our last graphic, and this is about inventory. So here's one of the reasons why home prices fall. So buyers have more choice. So this is what's months of inventory, being that, well, it says it just right here, months of inventory based on closed sales. So based on the number of closed sales in a month, there were 2.4 times that many listings on the market. Now that might look high to you, but the market never really, usually doesn't run out of homes, I suppose, or they're not selling that fast. Now look down here where where a whole bunch of listings were sitting on the market, were coming to market, and then just kind of sitting there, and then they got gobbled up because it's a time of year, November, December, where not a whole lot of listings usually hit the market, and there was a lot of demand, more demand than normal, in November, December of last year. So here we are, October of last year, one full month of inventory. Now we're at 2.4. That's actually more normal than you might realize, but it is affecting prices right now. Okay, so that's all the data there, and the next thing I wanted to go to here, back here in Mortgage News Daily, is how much those rates have dropped and why that is, and it's just because of inflation numbers coming down. We really need to see another month of that because we keep getting data that is somewhat mixed or revised, or the next day some big event happens, maybe in Europe or something like that, where they're adjusting their rate for interest rates, and that affects ours. um, Going over to this article here. So one thing that I keep hearing from just around, people think that there's a cycle in real estate pricing. No such cycle exists. You can't look at consumer price index and in real estate and find a cycle of ups and downs. The reality is that real estate tends to be a great hedge against inflation because it's the embodiment of what inflation is. It's energy, it's labor, it's commodities. It's things like lumber and copper. It's and then it's just the value of the dollar over time. So um, real estate being the embodiment of inflation, a lot of times the as inflation rises, really so do homes. Now, it's not necessarily happening in this case. You're seeing about year over year, about even, and it might end up dropping below that. And of course, that's because of the affordability. But I don't see it falling much more than that unless interest rates really rise even more. And another thing to note is that the last time there was very high inflation, like very high inflation in the 1970s, home prices rose. Um, and when everything costs more, that's what's going to happen. Another thing that's happening in um, the economy right now is, and especially in California, uh, there's a huge demand in housing. Even if the affordability isn't there, there's demand. And during the whole downturn in 2008, a whole lot of builders went out of business, and that really affected inventory. And the lending world changed a lot. So when the lending world changed, not a whole lot was being built because it wasn't being financed. And these builders, it took them a long time to really start building again and new builders to come about. Really affected inventory. So it's just the law of supply and demand. Law of demand and lower supply, and it never really caught up. And that's happening again. So a lot of builders are slowing down. Um, and I hear one thing from people like, oh, I'm waiting for home prices to go down, like new construction prices. It costs a lot of money to build a house, just in permits and fees. So like a electric meter fee, a water meter fee, environmental impact study, the traffic impact fee, and all your other little permits. In Sacramento County, you could be $100,000 in before you break ground. And I'm not talking about just the cost of the land. I'm talking about permits and fees. And then you have other mandates now, fire suppression systems. You go in all the new builds, they all have sprinklers inside the house, solar panels. There's a lot that goes into a house now that is very expensive. And you have labor. Labor is a lot more than where it used to be. So if a builder can't make a profit on the house, and if it's a risky venture as well, they just stop building. Okay, so let's get over to so this right here, this article that I have right in front of me. So this is something that came out just today, and I have this up here because of what happened in say '07, '08. Um, basically nothing that happened in that particular period is what's going on now. In that time, there was a whole lot of loans that were subprime. The qualifications for that loan were very, very low. Practically anyone would get one. And a huge amount of them were adjustable rate, where someone would have a monthly payment of say $2,000, and in a couple of years it would adjust out to something like $3,500. Well, the thought process at that time was, hey, well, if I can't afford that $3,500, I'll just refi back into the same loan. And the way the market's going, I can just sell this house. The homes are going up like $100,000 every year. Um, or maybe they're doing so well they'll refi into a fixed rate mortgage. But what ended up happening is there were so many foreclosures happening, those loans no longer existed. So people went to refi out of the adjustable rate or refi into a new adjustable rate so they can get that lower rate again. And that loan didn't exist. And there was nobody to buy their home because affordability was so bad at that time because the loans that they used to purchase that home were no longer there. None of that's happening. It caused a huge foreclosure crisis. So many people were underwater. They didn't have equity in their home and they could not afford their home. Now, something to remember about selling a home. People don't sell a home unless they have to sell a home or they're choosing to for a specific reason. So one of those reasons is unemployment. They can no longer afford it. An adjustable rate that made their payment change significantly. And other reasons, their job is changing, so they're moving. That's a reason why people would do that. That's a much less common reason to cause a huge jump in inventory. So the economy is actually fairly stable right now. There's not huge job losses. Unemployment is very, very low. Now, the reason why I have this up here is this line right here. Mortgage delinquencies decreased to new survey low in third quarter of 2022. So what this is the Mortgage Bankers Association's National Delinquency Survey. And they started doing this in 1979. Mortgage delinquencies, being pre-foreclosure, people late on their mortgages, is at an all-time low since 1979. So you tell me, do you think there's going to be a huge foreclosure crisis and now there's going to be a flood of homes on the market and the market's going to crash? Because that's what happened in 2007, 2008, right? Okay, so no mass foreclosures. Do you really think that we're going to see this huge market crash? No, we're simply seeing prices adjust to where people can afford it like they could back in January, February when mortgage rates were around 3.5%. So once we get to somewhere around that level, I think this slide is going to essentially stop. So really, there's one more. Let's see. Do I have another thing? Okay. Yeah, here. This is just today. Mortgage rates fall sharply to under 7% after inflation eases. The average rate on a 30-year fixed plunged 60 basis points. So that's 0.6%, down to 6.62%, according to Mortgage News Daily. Like CNBC references the same website I like to look at. It's a really great website. Compiles a lot of financial data. So essentially, what I'm thinking here, or really what's upcoming, the market has already priced in multiple upcoming Fed rate increases. And the latest consumer price index report was just released, showing inflation tapering off more than expected. This has sent rates to significant decline today, but we'll see what that means in the near future. There could be some sort of turnaround in that. We just don't know. Let's see. Essentially, we don't have a foreclosure boom. It's quite the opposite. I'm anticipating the market in early 2023 with buyers coming out in the third weekend of January. It's actually pretty common. Third weekend of January is a big month for that, or a big time for buyers to come out. And I'm expecting inventory to take a little bit of a hit at that time. Prices may come down a little bit more. Now, I guess some things that could change what I think would be happening if things stay on this current course is if there's hotter inflation data, there's significant unemployment leading to a serious recession. global economic disruptors, especially in Europe. So, something big happens over there. Monetary policy in Europe, such as maybe in Great Britain, um, their inflation ends up being a lot higher. I don't know if I said this in this little session at all, but whenever you see those guys on maybe it's on YouTube or something saying market crash coming, blah 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 blah, those guys are probably selling you a system to flip homes or buy foreclosures. They'll probably sell you on something that's maybe a couple $100 and it ends up being a whole system or course that will cost several thousands of dollars. That's really what that is. Those people are using scare tactics in order to make money, maybe even just some monetization for their, say, YouTube channel. All right, so that's a very long video, and if you actually watch this whole thing, I'd be surprised. But I hope it was informative for you. It's somewhat of a neutral market right now. It's good for buyers. It's kind of okay for sellers, unless you have a low amount of equity in your home. Then it's not so good. Also, a lot of sellers aren't selling right now because they have a 3% mortgage rate. Why are you going to sell and upsize, downsize to being now, I guess, about a 6.5, six and three, six and what 5/8? A lot of people just won't do that. They'll a lot of times people downsize to save money on their mortgage rate or their mortgage payment, but it might be a lateral move at this point. So, big reason why there's less inventory. And increased inventory usually drives lower prices. So, thank you so much. Really appreciate it if you watch this whole thing.